Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm Whitney Sewell, your host. Today, our guest is Joel Block. I'm so excited to have him on the show. You know, I was at a conference recently, and a lady asked me if I knew him, and I said, no, I don't. And the more I got to learning about Joel, I cannot believe that I have not known about him. His website's great. It has tons of great information, and he is just an expert in this field, probably one of the top experts that I've met to this point. Joel had worked at Pricewaterhouse before starting his own firm. He was a CPA doing tax work for hundreds of partnerships. He's a professional investor. He's been the principal in over 30 syndicated deals. He's a CEO of Bullseye Capital Fund. Now he's a professional speaker, speaks on Wall Street. Thanks for being on the show, Joel.
Hey, well, listen, thank you very much for having me. I appreciate it.
Yeah, Joel, tell us a little bit about how you got into the syndication business. You know, where you came from.
Well, listen, as a youngster, I worked at Pricewaterhouse doing tax work, and the last account at the firm that I was assigned to, I was doing the tax work for 500 partnerships. We were converting the books and records into tax returns, and I promise you, it was horrible work. It was just dreadful. But what I really enjoyed, I loved reading the partnership agreements, and I knew at that moment that I wanted to be a deal maker. I didn't want to be a tax guy. I wanted to actually be on the front lines doing deals. So I quit the firm. Met another guy along the way. We brokered a deal together, and then we said, hey, listen, why don't we try to buy some real estate ourselves? So we bought our first deal. We raised $7,500 from 22 different guys, and then we were off and running, and we did our next deal. And I think in the next couple of years, we did about 8 deals. We raised probably $3 million, and then I fell into a venture capital transaction in 1990 and built a company which I sold to a Fortune 500. So, I mean, I've done, once you learn, here's the deal. Once you learn how to raise money, once you get those skills under control, you can raise money for anything. So you learn to raise money for real estate, but then you can learn to raise money. Once you do that, you can raise money to buy a bridge or build a freeway or make a movie or build a company or do whatever you want. So, because the skills are transportable skills, they're very valuable skills. And what skill is more valuable than raising capital? I can't think of many.
So is syndication your main focus right now?
I run a hedge fund.
Okay,
so,
right.
So I'm not syndicating. Syndicating, to me, a syndication is a project. It's a one-time deal. You raise the money, you fix the building, you sell the building, you give the money back to the people, and you're done. A fund is an ongoing business that has a long lifespan. So you'll take the money in, you'll buy something, buy many different things, buy, sell. The money keeps coming back into the fund, so it stays in the fund. So I run a fund, and we own something close to 40 assets around the country.
So what type of investor is going to lean more towards a fund versus just a syndication one deal?
Well, first of all, they're not mutually exclusive, and it's very common that people that have funds also have syndications. Mm-hmm. So it goes in every direction. So there's not one or the other. But here's what I would tell people: if you have a lot of deal flow, then you probably want to control the capital so that you can pounce on the deal flow. And a fund would be excellent for that, because the fund is typically a blind pool where the money comes in advance. People hold on to that money, and then they go and they find deals. And when you come to the table with cash, you're probably going to get a better deal. So funds expect that they would generally get a pretty good profit. Now, you're paying for that money whether you use it or not, because once the investors give it to you, it's not their fault that you haven't deployed it. So a lot of guys will try and say, well, I'm only going to pay for the money when I'm using it. That's not really fair. That's not an investor-friendly term. And, to me, if it's not investor-friendly, it's going to be harder to raise your capital. So you always want to make your terms investor-friendly as much as you can. A syndication, on the other hand, you might have a fund that has a bunch of money in it, but you might have 3 or 4 guys that just want to do some special deal in a certain neighborhood or of a certain kind. When you set up your fund, you typically set up a charter, which is like a theme or a concept for your fund. And maybe you find a building that's outside of the charter, and you just have 3 or 4 guys. You can say, listen, you guys want to do this deal, whatever it is. So you can have a fund, you can have a syndication, you can have many different things all happening at the same time. It's not all that different from playing golf. You have 13 clubs in your bag, and you need to learn how to use each club. and syndication and funds and all the different tools that we have. They're all very high level financial tools, which I kind of refer to as the way Wall Street raises money. You have to learn how to use those tools.
So when is someone ready for the syndication business?
Well, I mean, put it like this. You're ready when you can raise money. And investors are not going to give beginners their capital. So if you're a beginner, people call me, hey, Joel, I don't have two nickels rubbed together, but I really could use to have some money so I could go buy something, make a living. Investors aren't going to give you any money. They're just not. Investors are funny. In fact, they don't like it when you practice with their money. They just don't like that. In fact, there's a reason that doctors practice on cadavers. I mean, those are low value targets. If they make a mistake, not a big deal. So you don't want to practice with somebody else's resources. So I would say that you have to have a little bit of a track record. And if you don't have the track record, then you need to partner with somebody that's got the track record. And you need to be able to come to the table 4, 5, 10, 20 fix and flips, or you need to have some number of, you have to have some kind of asset specialization where you're a developer and you've built homes, or you build shopping centers, or you understand assisted living, or you know student housing, or you do fix and flips of apartments or houses or something. You have to have some asset specialization that allows you to be able to say to somebody, hey, listen, I know what I'm doing. I've been around the block and I've made some money. And if we get together, then we can all make money together.
Tell us some, obviously you're an expert in this whole business, but tell us, as far as focusing on raising capital and being a beginner, give us some pointers on being able to make that happen. I know we need the experience. We need to find that partner. How do we do that?
You mean, how do you get your experience?
Well, how do we find somebody to partner with like that? Because if we don't have the experience in the syndication business, how do we get started? How do we find that person? What value do we bring? What does that look like?
It's not so much important that you have a partner for the syndication part, because that's not the important part. If somebody says, well, how many deals have you syndicated? They're probably not going to say it exactly like that. What they're going to say is, well, how many deals have you done?
Right.
Whether you've done a deal, just a fix and flip house by yourself with private money or hard money, that's not a big deal. Or whether you've done a syndicated deal, investors don't really see that as very significantly different. They're different, but they're not significantly different because the underlying asset is the same. So, you need to be going to real estate conferences where you're connected to people who are doing other real estate deals and where you have commonality with those people. So, the first thing that people have to understand, and it's a surprising concept to a lot of people, but the money is not made in the real estate. You know where the money gets made? You know where it comes from? The money gets made in the money. When you control the money, you can buy all the real estate you want. If you don't control the money, then you are going to have a hard time making anything. And so when you're first getting started and you're cobbling together hard money, private money, joint ventures, whatever sources you're using, and you do what you got to do to make your money, you're probably not making a lot in your first, several deals, but you're getting your background, you're getting your experience, you're getting your track record, and you're meeting other people, you're networking with other people. I mean, listen, RIA clubs are filled with these people, national events of all kinds. There's all kinds of real estate events going on all over the country all the time. And you need to participate in those events, and you need to be meeting people that see the world in the same way as you, that have complementary skills. For example, somebody might be a real estate broker and they have great market skills. You might have asset management or property management skills. And so they find the property, you fix the property, you lease the property, and they sell the property. So, you have different skills that different people on the team can do. And you got to build your team. And between all the people on that team, you're probably going to have a track record that becomes fundable. And that's really what you're looking for, is to have a fundable track record of guys that work together. And that's really powerful. So I would tell you, network as hard as you can, but you don't just show up somewhere with a business card and you throw it on the table. You have to go deliberately, strategically, and you have to look for what you're looking for. And what you're looking for are people that have complementary skills to your own, and then you can be successful. And then once that happens, then the group can say, well, gee, maybe we can raise some money as a group together, and everybody has to be part of that process. They all have to go find some of the capital, and more likely some guys going to be better at it than others, but different people. because everybody's got their own tribe, everybody's got their own following. And one of the things that people need to do, and a lot of real estate people don't think about this, you need to build a following. People that just think that you're the cat's meow, that you're really good at what you do. And then eventually they're going to say to you, man, you are really good at making money in real estate. Can I ride on your coattails and give you a little money to fund your projects? And the syndication business is the best way to fund those projects. Instead of having somebody give you a private money loan and say, here's some money, it'd be better to put them in a pool instead.
Are there specific types of investors we should focus on? Like maybe a certain net worth or certain whatever.
Yep. There are certain guys you should focus on. There are other guys you should not focus on. I cannot tell you how many people come to me, and I've taught a lot of people this business. Twice a year we do a conference, and so we teach a lot of people how this business works. They're small conferences because this is not a business where we're going to pack an auditorium with 500 people and teach them these skills. And we probably build more syndications and funds than anybody in the country. I mean, we build a lot. So here are some parameters that I would give you. People call me all the time and they say, Joel, don't worry about me. I could raise a lot of money. I am friends with a billionaire. Well, let me promise you, billionaires are not your clients. Billionaires do not need us. They don't need guys like us. Billionaires and very wealthy people develop an entourage of stockbrokers and life insurance agents and other people that are surrounding them all the time. And they don't want a dollar to leave the net that they've built around these people. Because when money goes to guys like us, it's not commissionable to people like that. We're outside of their world. We're called an alternative investment, which is not commissionable to them using the structures that they have in place. So for the most part, they are not really good people for us. The best people for us are people that have a net worth typically between $1 million and $10 million. These are people that they're still aggressively looking to make money. They're people who are taking risks. They're people who make their own decisions. They control their own capital. And for all of those reasons, those are people that you want to connect with. They're also not that hard to find. They're not that hard to connect with. And they're out there. And so, forget about these billionaires. I've never seen anyone bring money in from a billionaire, unless they're related to them. It just, it's not. And then if they do, if there's ever any kind of a lawsuit or a problem, guess who's going to have all the power? It's not exactly what you want. And billionaires don't invest in the kind of increments that we typically look for either. And that's a good question that we can get into. But, all these kinds of issues they're complex. And a lot of things can be avoided by dealing with decent guys that are just hardworking business people that have a decent $1 to $10 million net worth, maybe 1 to 20, something like that.
Nice. You had mentioned that those types of people, $1 to $10 million, are not hard to connect with. Can you give us some pointers on how to connect with those individuals?
Well, I always kind of tell this little story about the yellow car. When's the last time you saw a yellow car? I don't know. Most people don't see very many yellow cars. But if I tell you to look for yellow cars, you'll see one every single day. There are yellow cars on the road, and you'll see one every day. Same thing with investors. The reason that you're not finding them now you don't know where to look for them now is because you're not looking for them. Because if you found one, you wouldn't have any use for that person. What people are typically looking for, who are earlier stage than syndicators, is they're looking for hard money lenders, private money lenders. So they're looking for them and they find them. They go to the RIA clubs and other places, they find them. But those guys tend to be semi-professional and professional investors. And they tend to end up with a lot of the control in the real estate transaction. At the very least, they have the control of saying yes or no. And if they say no, then you can't feed your family with that deal. So you got to go find another guy. And that's exactly what the problem is that's why it's not good capital, because you don't have control over the yes or no process. So where are these guys? They're everywhere. They're in bars, restaurants, they're in lobbies, they're in hotels, they're in elevators. They're just everywhere. And you just have to start talking to people. And you don't say, what's your net worth? You don't start like that, but you start by, what do you do? And, listen, I run a real estate fund, and we buy distressed properties and share the profits with our investors. And if people say, gee, that sounds interesting, I'd like to hear more, then you talk to them. And if they ask you what the weather is in Milwaukee next week because they're going there, then they're not interested, So you just have to talk to a lot of people. and then mark down on a sheet of paper which are the people that are interested in talking to you further, and you work those people. And so you start looking for people who are looking for a passive investment. And that opens up another discussion. And that is that real estate brokers will all tell you, well, I know a lot of real estate investors. They know active investors that want to actually buy the real estate. Syndicators are looking for passive investors who just want to give them the cash for them to go buy the real estate. And that's a really significant difference. So, I'm not saying that real estate brokers don't know people. They know a lot of people. But just because they're in real estate doesn't necessarily mean that they know the right people. So just think about the concept of looking for passive investors, 1 to 10 million. Those are your people.
You had briefly mentioned about friendly investor terms earlier. Can you elaborate on that a little bit? How do we know we have friendly investor or terms, and what does that look like?
Well, investor friendly, are terms that investors like, which are also okay for us. And, one of the things that very frequently goes wrong, you need an attorney to put together your documents, your private placement, your operating agreement, your subscription agreement. They need to review any marketing materials. I'm not an attorney, by the way. So you need, an attorney to review all of this stuff. Attorneys, however, are licensed to give legal advice. They don't give business advice. And things start going wrong when attorneys start giving business advice, because attorneys are generally not in the marketplace with investors. They're generally not raising capital all day long. They're generally not interfacing with investors all day long. And there just are a lot of things that go wrong. So sometimes attorneys whose job it is to advocate for you advocate so hard that they ruin your deal. And that's why you have to really be taking a hard look at what's investor friendly. And attorneys may or may not always know what this is. So for example, an investor friendly term, can an investor sell their shares to another investor? Let's say they invest and it's a 5-year deal. And at the end of 2 years, they want out, Well, you don't want to let them out because now your money's in real estate. What are you going to do? Liquidate the building? You can't penalize everyone because one guy wants his money back. So, can the guy sell his shares to someone else? Well, it would be very, very friendly for him to just be able to sell anybody he wants, but you can't let people do that, because if people do that, number one, if there's too many sales, then you could ruin your SEC exemption. That could be a big problem. But number two, what if the guy sells it to somebody that you don't like, or that is just a really big problem for your group? Because these groups are small. You're kind of like on a team for a period of time. In fact, I tell investors when they come on with us, listen, we're going to be on the same team. We need to get to know each other a little bit. We need to really understand how each other works. And that's really going to be important to all of us being successful. So, that would be very friendly, but just because it's friendly doesn't mean it works for us. So what we do, for example, is if somebody wants to transfer the shares to an heir, for example, to a grandchild or a child, that's fine. They can do that without asking our permission. If they want to sell it to a third party, then they have to ask our permission. And we don't necessarily let them transfer their voting rights, only their economic rights. So they can't, if they transfer to somebody who is, prickly, so to speak, we don't have to deal with that too much. So, it depends on what's the rate of return. How does the waterfall work? How do the fee structures work? All of those things, all of the control factors, the voting factors, all of those factors are very significant in creating an investor-friendly environment. And, you want it to be investor-friendly, but you don't want it to be so friendly that you don't make any money. There's a fine line and a balance. And there's some things that investors are sensitive to that you want to make sure you give them. And there are other things that maybe they're not so sensitive to that you don't want to give up so fast. So, you just kind of have to know what you're doing in order to get that figured out. And you need to be around people who know what they're doing, and you need to get involved with people. And by the way, that's the reason that people come to our conference, is really to understand and take a deep dive on these kinds of issues and really understand the great formulas that guys like us use, and really understand the way that this business works in a significant way.
Awesome. Well, changing gears just a little bit, what would you tell yourself with the knowledge you have now and experience you have? If you could go back before you started in real estate, what would you tell yourself? What would you say to do different?
Buy more real estate. Buy more, buy faster, raise more capital, do more deals, and probably hold longer term. Of course, that's something that you could only know over time, but over time, real estate does very well. So we're kind of in a economic cycle where there's not a lot of appreciation, so holding doesn't feel real attractive. So that's more our fund, for example, it's more transactional. But in the long run, holding is really, really good. So you probably want to have more than one structure. You want to have one structure that's maybe longer term, another structure that's maybe transactional. And, you can kind of balance those couple things. So, and that's why you said earlier, is it syndication or fund? Well, you need to have a combination of different things going on.
What's the hardest part of the syndication process or business?
The hardest part, well, for most people, the hardest part is raising the capital. I mean, that's always the hard part. I mean, people just say, listen, just give me the money and I'll do the rest. Raising the money, here's the funny part though. The sale doesn't happen when you sit down with the customer, the prospect. The sale happens long before, because you have to conceptualize the deal. You have to think through, exactly what kind of real estate you're going to buy, what the charter of your fund is, what the terms of your deal are. And when you put your terms together, there might be 200 decisions that you have to make about what kind of a structure you're going to have and how things are going to work and what the investors are going to get. I mean, there's a lot to it. So all those things factor in, so that when you finally sit down with the prospect and you tell them what the deal is, they understand that, all the different components. And then you, the syndicator, have to understand the deal very well. You don't have to memorize it, but you have to understand your own deal. And if an attorney puts it together, you may not even understand your own deal. You have to really, be counseled on what it is that you've put together. And by the way, this isn't like, like an eviction where you call an attorney and say, would you evict the guy in apartment 13? I mean, you have to be intimately involved in putting this together. You have to, our guys, we dictate the terms and we give them to the attorney. And, we don't just, let the attorney decide whatever the attorney wants to do. I mean, we dictate all the terms. We literally send a template with a couple of hundred decisions made in advance. And we say, here's what we're going to do. This is what we want. Build this for us this way. And that's what the attorney's job is to build it for us the way that we ask. So the hard part is always raising the money.
What's going to be the top reason that you've seen syndicators fail in the business?
Well, number one is because their terms are terribly investor unfriendly and they can't raise their money. That's number one. Number two, they don't have the asset class expertise that they represent. Investors bet on them to have asset class expertise. And if they don't bring that to the table, that could be a real problem for them. So you have to make sure that you bring that expertise to the table and that you're good at what you say you're good at. And then you go and execute the way you plan to execute. Listen, markets can go against you. Things can go wrong. That always happens. That's just kind of how life works. But you got to do really good at what you know how to do. And if you do that, then you're going to be successful.
What's the number one thing that's contributed to your success?
I'm an expert. I mean, I am really good at the things I know, and I keep myself in a little box, and I know what I know, and I don't jump out to do a lot of other stuff. And one of the things that I always say is charge a lot for what you're good at and give everything else away for free. And that really, so you want me to come over to your house and help you to fix your computer? That's fine. I'm not going to charge you for it, because if I screw it up, you got exactly what you paid for. Nothing. So, that's how I look at the world.
I like that. You said charge a lot for what you're good at and give everything else away
For free.
Yeah, for free. I like that.
And that kind of prevents you from charging money for things that you're mediocre at. Nobody wants to pay you for being mediocre. Nobody minds to pay an expert, but nobody likes paying mediocre. So you want to make sure that you stay doing what you're good at. So get good at something. If it's fix and flip, if it's apartments, multifamily, if it's commercial, industrial, it doesn't matter what it is. Get good at something and stick with it. Now you can expand over time, but start somewhere and then morph into something else over time. So that's a really good success formula.
What's something someone can do right now to improve their syndication business? Maybe that's something that of that's common that needs to be done, but maybe most people don't.
what they could do is they can get their track record for their real estate skills under control. I mean, if it's going to be real estate syndication, they need to get their track record under control, and they need to start building a team, and they need to start building a tribe, a following of people who think that they're the cat's meow, that they're really good, because those are the people you're going to call on, and you're going to say, hey, listen, I'm doing some deals. Are you interested in potentially getting involved with me? People who know you, like you, think that you're doing great. Those are the people that are most likely to follow you. So you want to make sure that you're, building a list of who those people are, and that you're communicating with them. And what you might do is build an email list. You might say, hey, we just flipped another house. Hey, we just did this, made 20%, whatever. Just keep telling them what you're doing, and keep doing it. Keep building your track record. And all those things together are going to add up to some real success.
That's awesome. Tell us about something you're excited about in your business right now.
Well, listen, this business, this is an awesome business. I love this business. And one of the things I love most about it is I love sharing what it is that we know. And twice a year we do these conferences. So if I could share that we are coming up, and we have our October conference coming up, the 21st, the 24th of 2018 in Las Vegas. And then we have actually a special one-day event following that. We've never done this before, but a good friend of mine who helps me with a lot of my internet marketing, a lot of my stuff, he's going to be doing a full day of marketing for investors the day following the symposium. So you come to the symposium, you're going to learn more about how the syndication business works than anywhere you can ever go. It's not about law. The syndication is a sales and marketing business. So you have to understand how to build your operating agreement, how to build the terms of your investors. We spent a couple of hours on some legal stuff, but we talk about, because I don't want to turn anybody into an attorney. I mean, my goal is to just get them to understand the way things work so they don't make any mistakes, or our attorney comes in and does a little couple-hour program. But for the most part, the real focus is really about how to construct a deal that investors can say yes to. If you can't give people something to say yes to, they won't say yes, and you won't get any money. And if you don't get any money, then the whole exercise was a waste. So the only goal that matters is that you're successful in raising your capital, and you have to, create a deal that's going to work so people can successfully review it and say, boy, I like what you're doing, and I want to be involved in this. So that's really the name of the game there. So that event's coming up in October, and if they can't make October, we have April of 2019. So, that's kind of where we're at.
Awesome. Where can the listener learn more about you, Joel, and the conference?
Well, there's two different things. One, if you want to learn about the conference, go to dealmakingsymposium.com. And if they want to opt into our list, we have videos, and every week I put out one or two question answer videos. People write in questions, I answer them, and your listeners are welcome to write in, and I'll answer questions that people have, and we'll circulate them. And so they can go to syndicatefast.com and they can opt in. And I think you probably could opt in on Deal Making Symposium too, but we've got the two different places they can opt in. And once they come into the list, then they can, they become part of the family and they get our stuff. It's a very closed, tight community. We've got incredible alumni. Our alumni frequently come back to our conferences because they like to network. They like to meet other guys. They like to get reinforcement of the material. And it's powerful for everyone. Wow.
Well, Joel, you've been a great guest. I really appreciate the value you've provided to the listeners. And, I appreciate all the listeners for listening today. And we hope that you'll leave a comment and rate the show. And we will talk to you tomorrow.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.